Welcome to the Farm Business Resilient Program run by the ACT-NRM. And we're going to talk about business or profit, which is very important, probably a very important part of any agricultural business. And the first cab off the rank is, what is profit? Because profit is to business as is breathing is to life. So we've really got to start nutting down to what are the parts of profit that we need to understand and to work with. So if I go to my iPad now, and let's do a model of profit. And this model of profit is represents any and every business that you know of on Earth. And I'll bring this one along as part of an agricultural business. We have these costs that we incur before we even open our production side, and these costs would be rates, electricity, we need someone to run the business, so it would be labour. And with labour, you get the on costs of labour. You would also have vehicles and bikes and things like that for general purpose, maybe a front-end loader, accountancy, admin, all that type of thing. And these are what we call overhead costs. Now, you might have heard people call these costs fixed costs. We don't like that term fixed costs because they're not fixed, and we really can alter those to how we need. Then the next set of costs. So these would be, you say in a cropping situation, you'd need a tractor and planter. You might need augers. You could also need fuel trailer, etc. Even if you're getting contract labour. With sheep, you probably need a shearing shed and yards. And with cattle, you'd probably need cattle yards, yeah? Now, these are division specific. And what we mean by division specific is that if you weren't in that business of cattle or sheep, then you would not need those items of plant, machinery, or infrastructure. So we like to call these ones divisional overheads. So if I wasn't in cropping, I wouldn't need a tractor, a planter, an auger, fuel trailer. If I wasn't in cattle, then I wouldn't need cattle yards, a cattle crush. And if I wasn't producing sheep, then I wouldn't need a shearing shed and yards, etc. So they are division specific, and they, if you discarded that division, then they would disappear. Whereas your general overheads are just opening your doors for business, getting the management right and everything else. So all we've done at the moment is spend money. Now we need to actually start to get into the production part of this business. So if I'm going to sow a crop, I'll need seed and fertiliser. Maybe spray. If I'm in sheep, I'll need to start shearing them and drench probably. And if I'm in cattle, I would need cattle animal health, etc. tags. You'll notice with these costs that these costs then become a part and parcel of how many you run. So with the seed and fertiliser, that price or those costs will increase as the hectares of cropping increase. With the shearing, the more sheep you have, the higher the shearing cost will be because it's done per head. The cropping's done per hectare. Cattle animal health, also, it's done per head. How many tags I need, whether I'm drenching them or backlining them. So these costs go up with the number of animals that we're carrying or the number of hectares that we're sowing. And we call these direct costs because they're directly associated with our production. Not much of a business at the moment because all we've done is spend money. We've got to actually start to make some money. So we're going to overlay here income. Hang on, I might just increase that a bit. Income coming in, and this is coming from the fruits of our labour. And it will change the amount of income with the amount of units that we have. So if we're not carrying that many units, then that will be a lot steeper line. Going units along the bottom. So then it becomes less, you can carry less cost for the amount of units you're going. And this is getting into scale. Let's just put it through the middle here. And we'll call this one income. We have a break-even point in the middle here. So where the blue line intersects the green line, that is our break-even. We are making money in this section here. That is where we're profitable, and we're losing money underneath. We're spending more than we're making. Okay, so that's a fine model that works for BHP, any listed company you like. How does it associate with us? So what we come down to is the 3 secrets of profit. So the first secret is the number of units or the turnover. As you go along that line, sorry, I've got the wrong, then the number, as you increase the number of units and you can keep your overheads and your divisional overheads the same, then you have a higher chance of making money. So it's what we call the turnover. Oh, it'll help if I can spell. The next one we can look at is the overheads. So what overheads are we carrying? And we need to be able to control those overheads so the cost of running our business isn't too high. So we have our overhead. And the last one that we want to look at is what we call our gross margin. So our gross margin is the relationship between the cost of production, the direct costs, and the price that we're receiving. So actually I might expand that one out. And these are the three secrets of profit. And we've got to find out which one is lacking. So we want to increase our gross margin, we want to decrease our overheads, and we want to increase our turnover. Easily said, but we've got to find out where our issue is. One of my gripes with agriculture in Australia is all we do is focus on gross margin. And that's really just a third of the business that we're looking at. So I'll take you back to the PowerPoint, and I'd like to expand on what I am talking about. So that should have come up by now, and we're looking at the model. We want to increase profit, increase gross margin, reduce our overheads, and increase our turnover. And we can start to get a mind map of what the profit is. So we've got gross margin per unit. So that's dollars per head or dollars per hectare that we're producing, that we're making from our production systems. Then we have our overheads, and our overheads can be classed pretty easily with land, with labour, and with admin. And then we have our units or our turnover, and we have the number of hectares that we're cropping, we have the number of cattle or number of sheep that we're running, and the stocking rate and utilisation. So this is a basic model of any business, but this is an agricultural business that we're focusing on. So the first place I'd like to start to look at is the gross margin per unit. And I'd like to ask you, do you have any lazy enterprises? So what do I mean by that? And a great example is, does use size matter? So these numbers have come from two studs that are in my district. And I've put up an area of 1,000 DSE because our land area is always our most restrictive part. And we have two studs. One stud aims to have a mature aged ewe at 55 kilos, which is at 1.43 DSE over the year. The second stud aims to have 80 kilo ewes, so big framed animals. And over the year, they're at 1.81 DSE average. That takes into account lactation, third trimester, etc. They're both being based on a number of weeks of lactation. They're both exactly the same. So the total number of ewes that we can run on that 1,000 DSE, the first 55 kilo ewes, we can only run 746. With the 80 kilo ewes, we can run just 552. Both of these studs are highly fertile. So they're merino studs, and they're really concentrating on their fertility, amongst other things. And they're both producing about 140% lambing. So the 55 kilo ewes produce 1,044 lambs, and the 80 kilo ewes produce 772 lambs. The equivalent of wool, if the 55 kilo ewe is producing 6 kilos, then to be the same, the 80 kilo ewe needs to produce 7.5 kilos to give us the same wool per DSE, dry sheep area. A lot of people will tell me that they go for the big ewes so they can get bigger lambs. And what I find incredibly interesting is it's counterintuitive, where the bigger the cow, the smaller the weaner. The smaller the cow will have the biggest weaners. And it's pretty much, although we haven't got really good data out of sheep, but it's pretty much the same. So the smaller ewe has a lower maintenance level, and it can provide or apportion more milk to the lamb during lactation, and it ends up with a bigger weaner because of it. And this is well known through the industry. So I can't see the fascination with big animals. Another area with gross margins, and gross margins aren't the role of gross margins is to compare enterprises, not so much as a figure of profitability, because we know that there's two other parts of profitability. That's turnover and lower overheads. So it's only a third of the part of profitability, but it becomes incredibly important if you want to compare overheads. And this is an example that we have where we have the cows are producing a gross product, and this is what we'll go through that shortly. Then we have split it up. So as soon as those heifers and steers are weaned, they go into their own enterprise. And we have gross products for the heifers and the steers. Now, those heifers, the ones that they want to keep, that cow enterprise will have to buy those heifers back, because the cow enterprise has sold the heifers and steers into those enterprises for market rate. So it's exactly the same as if you'd gone to the market and bought those steers and heifers without breeding them. And you can start to see in this example the difference between the different enterprises. So in this, the cow breeding is returning twice the dollars per DSE as the heifers and steers. Now, that might be reverse in other cases, but we need to know this type of stuff. And that's where the role of gross margins comes into. We've got to find those lazy enterprises. So if we went into this business and we sold the heifers and steers at weaning, and then we bought in PTIC heifers from the market to have replacements, then this business would be $150,000 better off, pretty much. I think it's about 148. I've done the numbers. And I would suggest that if you sold everything as weaners, then your workload and your business simplicity would fall dramatically. Because we've increased the cow numbers to replace those steers and heifers that we've sold as weaners. This is stuff that we need to know. So I call this low-hanging fruit. And this is one of the most exciting parts of analysing a business, doing the gross margins, creating the enterprises, and being able to compare them well. Going back to our mind map, I'm not going to look at admin. It's, their rates, insurance, and all the rest of it. They can be moved. They need to be checked. We need to go through them and make sure that we're not paying too much money for insurance, whether we can do without phones, whether we can do without some labour, etc. Scale's a big one. Are we running enough units? And I'd like to look at scale in a different way. I think scale has a lot to do with labour, the labour ratio. Is our scale matching our labour? Now, if we're managing the place and living on it, so we're an owner-operator, we're part of that labour equation. And we really need to see how much labour that, so instead of trying to get bigger and bigger, maybe it's the labour on it that's causing it. So this is country around here in Wellington. It's really hilly, rough country. My brother has properties in this type of country, so I know it well. And this is about the current cost per hectare. So in this example, we're going to buy 400 hectares at $2,500 a hectare. I would suggest this is way overpriced. So this country, we've had to fence with pack saddles. That's how rough it is. But I know that 400 hectares will run 100 cows on its ear. You might have to destock in severe droughts, but pretty much it's a very comfortable stocking rate. So it's going to cost us $200,000 to stock it. Don't get hung up on the numbers. This is more just to give you an idea. So the total capital required is $1.2 million to go into this business. The gross margin, so we sell 95 wieners at $1,200 a head. So our total income for this property will be $114,000. Let's check the gross margin. So we've got a gross margin or gross product of $114,000. Labour. So if we're running this on the side, it should really only take us about 5 hours a week. We might move them once a week, set up the water so it's pretty safe. We don't have to check it every day. And I've put there $50 an hour because the person that I'm employing, me, I come with a ute and a bike and tools. So I'm fully serviced. So the labour part of this business is only $13,000. Estimated overheads. I've really whacked this one up. So that would include rates of probably $4,000 to $6,000, and then your fencing I've put in here because usually it's all run on dams. So we've got a profit of $71,000. Now let's have a look at the return on assets. A total of $1.2 million has been invested. Our return on assets is 5.9%. And a return on assets of 9.5% in agriculture is putting you well within the top 20%. And this is at current land prices. So it's how you set up your business, your strategic way of setting up your business is how it makes it profitable. I see so many businesses that have been set up that will only make money when everything is perfect, when the seasons are perfect, when the prices are good, everything's in your favour, and struggle in those times that they're not. Another one is cropping, and I've already raised this, but divisional overheads. How much junk do we have? And this would include those that are just growing fodder crops. So you're in the business of grazing, but you're still carrying tractors and planters and things like that. So say if we're planting 1,000 hectares annually, I go out and buy a good second-hand tractor and planter for $500,000, and I'd say you hope that it's pretty good. Your depreciation on that is $50,000 a year at 10%. We also have an opportunity cost. Now, that opportunity cost is because we put $500,000 out there. We could have invested that anywhere. We could have put it in the bank for 4%. Could have invested in a house in town. I know houses in town, I'm getting over 10%. I could have invested it in more cattle or sheep, and I know they're, you'd hope to get those up to around 60%. So we've got a lot of options, but we've chosen to invest in rust. So we need to put that opportunity cost in there to recognise the capital that's tied up. R&M, say $10,000. So that's fixing up an old machine, putting oil and grease into it. No diesel. I'm not counting diesel here because I want to compare it to a contractor, and a contractor will usually come in dry, and we have to supply diesel for them. Now we've got to put a bum on a seat, and whether it's ours or someone else's, if we need to price that in. So I'm saying that for 200 hours, it's going to take us to plant 1,000 hectares at $40 an hour, so that's $8,000. Annual cost is $118,000 a year. Now I know around here in the central New South Wales that we can get planting done at $50 a hectare. So a contractor would cost you $50,000. And we need to know that, how much rust we've got and whether it's worth owning that rust. So now people will say, oh, but you don't get your crop in on time or off on time. And I would suggest that now we know a cost. So in this case, it would be $68,000 a year it's costing us, so we can sow our own crop at the right time. Is it worth that cost? Or do we go with a contractor? The last one I'd like to look at is land. And I went to a really interesting business, and he's a good operator. He was running Wagyu cross, getting top price. I think he was selling at double what a standard breed would be. But he could only make about 3% return on assets. And he just couldn't understand why. And it didn't take me long when I arrived that everything on this place was absolutely smick. The pastures couldn't have been better. He's fertilising everything. He's re-sowing everything. The fences were magnificent. Everything was magnificent. And he said, I just love doing up places, just love fixing everything up. But it was costing him. So he was over-investing in capital expenditure, over-investing on what that property or that business could generate. So we've got to be careful of how much money we want to spend on all those different things. Now we're going to change topic a little bit, but we've got to have divisions. If we want to start doing gross margins, we need to break up the divisions that are involved. And the divisions are different industries that you're involved with: sheep, cattle, crops. And I'd like to ask you what divisions you have. How many divisions are you carrying? If you're growing a fodder crop, that is a cropping division. We need to start selling our fodder crop to our animals to see how profitable the fodder cropping is. Then we have enterprises. Enterprises are different forms of production in each division. So in a cattle division, we might have breeding, backgrounding, fattening, and agistment. Sheep, we might have merinos, wethers, crossbreed, fat lambs, agistment. Cropping, any species you like to know. But we must be able to identify the income and direct costs for each of those enterprises so we can start to compare those enterprises. This is where the low-hanging fruit is. This is where we can make big differences to the businesses that we're running. So we have Jack and Jill beef and oats. They breed their own cattle up to 200 kgs, and then they background them up the second 200 kgs, and then they're growing bullocks out to 600 kgs. And they're using fodder oats, forage oats on quite a few of those enterprises, I'd guess, on the backgrounding and on the finishing. How many enterprises are Jack and Jill running? Well, in this case, they're running 4 enterprises, and they need to be able to separate those costs between those enterprises. And that forage oats needs to be sold to the cattle. And in that case, we use an agistment rate, because if you didn't have that forage oats and you didn't have feed for them, you could agist them elsewhere. So all it is an agistment return for that forage oats. Direct costs, as we've covered, is changes to the varying number of units of production. Unit production is either an animal that you stock or a hectare that you farm. So I'd like to ask the question, how many enterprises do you carry? And people will be surprised if how many enterprises you're actually carrying and operating, especially if you're a breeding enterprise and then you're fattening the animals through. And once the animal is weaned, it becomes a separate unit because it can be sold as a weaner. And that's the time that we change it from a breeding enterprise into a weaner enterprise. So we've got all these enterprises now. Now we need to do a trading account. The purpose of a trading account is to account for the cash and non-cash movements to calculate the gross product. The gross product is the dollars for your hard-earned sweat and tears. the economic value of your turnover, where the real value of all the hard work is done. So let's look at a simple cow-calf operation. We run 100 cows, we produce 50 heifers for sale, $1,000 a head, and 50 steer weaners, both weaners straight off mum, for sale in April for $1,000 a head. And that gives us a gross product of $100,000. What happens if instead of selling them in April, I reckon I'm coming into a pretty good winter, and we decide to keep those heifers and we put weight on them? We might even look to, if the season continues, we might even look to join them and sell them as PTIC or as cows with calves at foot. Suddenly, our gross product, if we're only looking at cash, falls to $50,000. But that's not right, is it? Because we're carrying more animals. And this is why we need a trading account or a stock flow, where we're taking into account what is happening in our cash, in our bank account, and we're taking into account what is happening in the paddock. Same with cropping. Sorghum crop, we've got 100 hectares, yield of 500 tonnes. We sell it for $350 a tonne. So our gross product in cash terms is $175,000 if we sell it all at harvest. We don't like the price at harvest, so we only sell half and we keep 250 tonnes. Then our gross product in cash terms halves. Is that business or is that gross margin losing money? Absolutely not, because we've got it sitting in the silo at home. So we're not only measuring the cash, but we're measuring what is physically happening in the paddock or the silo. So we've got the sales and purchases. They're pretty easy to account for because we usually get a summary from our agents. Then we've got to measure the difference in inventory. Has the inventory increased or decreased over the period? And finally, when we start having different enterprises, then the breeding enterprise needs to sell their animals to the weaner enterprise. And then the weaner enterprise needs to sell the animals to the finishing enterprise at market value. So they're the internal sales and purchases, and that is our trading account. We have gross income, less cost of sales. Where does the information come from for our stock flows? It comes from stock flows and crop flows. What information is on them? We need to record what is on hand at the start of the period. We need to record the purchases, what was added, what was harvested, what was marked, the natural increases. We need to record what went out. And then importantly, we need to record the deaths and the transfers within enterprises. So we need to record how much grain or how much forage did that crop supply to that animal or that animal enterprise. We need to take into account the animals in a breeding enterprise that have been weaned out and have been sold into another enterprise. And that leaves us with what's on hand at the end: the livestock numbers, the grain in the silo, and the wool in storage. It's a reconciliation. So we subtract what went out, add and subtract the deaths and transfers, and that leaves us with the end. And a stock flow spreadsheet looks something like this. We got the opening numbers, we have our sales and purchases in the bottom, we add the sales, we subtract the purchases, and then that will be the end. And this is what it looks like. So we start off with our class of stock, and we have our bulls, cows, calves, bulls, heifers, and steers. In this case, they've got a special bull for the heifers. The opening number, then the opening value, and we'll go into values pretty shortly. Then we have natural increases. So we're only getting calves from our breeders and not from our heifers. I'm guessing they're being transferred into the breeders at a PTIC. Then we're looking at the purchases. In this case, they've only purchased 7 bulls. Then we're looking at the sales, and these are quite a few more. So we sold 4 bulls and 2 bulls, sold 6. We've sold 150 cows, cast for age, dry. We've sold 90 heifers, and we've sold all the steers. We have the deaths, and then importantly, we have the transfers. So we've got the heifers, PTIC, 260 being transferred into the breeders. We've got the calves, 860 being transferred. Half is going into the heifers and half are going in with the steers. And then that will end it with our closing. Once we get our closing, then we have a gross product. Now we have this area with the transfers. Some clever spreadsheets that we have will have the movements that you'd put in, and it'll automatically calculate for you. If it's reasonably simple, it shouldn't take much. This is another example where we've put the trading account into this form, and you can see we've got the enterprise. The heifers have received $234,000 into their enterprise, and the breeders have received $473,000 into their enterprise, and they've had to pay out $234,000. So they've purchased something, and you can see where these have been purchased. So they've sold the weaners half into the heifer and half into the steer enterprise. And then the PTIC, the heifers that we've kept, have been sold out of the heifers, into the breeders. We value animals differently. So if you have trading animals or weaner enterprises that we're aiming to sell, we will always mark them to market. So the opening value will be marked to market at the opening of the period. So if we're opening the period at the 1st of July, it will be the current market value for that item. And then at the 30th of June the next year, it will mark to market again, what that current value of that animal is at that time. Because they are intended to sell, and we've got to work out whether we're making money by holding them or we should have sold them. The breeding animals aren't intended to sell. We're intending to keep those. So we don't want to mark them to market. We will open and close those at the same value. Because if we didn't open and close them at the same value, that would reflect a profit or a loss in your profitability. And that's not adding any new information, because we know that will be different on your balance sheet. And that's fine, we'll leave it up there, but we don't want it to corrupt our profitability when we don't intend to sell them. We also need to do a crop flow. So a crop flow looks something like this. And we've got wheat and 50 hectares, and we year open, we've got 350 tonne in the silo, and we have a current market value. Then we might have purchased some for sowing, and we've paid a stud rate of 850 per tonne. Then we have a yield, 3 tonnes per hectare, pretty good year. and that will give us the tonnage available to sell. Sowing, so you're always going to use a bit of sowing. In this case, we've used what we've purchased earlier. Then we have the transfers in and out. So transfers out, we've had agistment, and the value of the agistment of the animals there was 12,750, and that would have gone to the sheep enterprise. So in this case, the sheep were run on the stubble paddock between crops. The sheep must pay the cropping enterprise for that grazing. And then we have our sales and our price, and then that will leave us with the closing. How much is left in the silo at the end of the period or at the end of the year at current market value? Well, pretty easy. Have a quick look at hay. We haven't had any at the opening. We haven't purchased any. It has produced, what's that, 5.33 tonnes. We didn't sow any. It's sitting there in the paddock. It transfers out. So we fed 100 tonne at $15,000 to the cows, and we sold the rest. So we don't have any left. We've got to start taking into account the cost of this fodder that we're keeping for the animals and charging the animals for it, because that's just cross-subsidisation. And then if these spreadsheets, they will give you the gross product that you need for each of the enterprises. We also need to account for winter crops, because winter crops cover 2 financial years. In this case, in a winter crop, we really start preparing that paddock for a winter crop around the 1st of January. And then by the 1st of January next year, that crop is finished. And so what we need to do is to move those costs that we've incurred in the previous financial year and bring them into the year that the harvest has occurred. And then we get the second winter crop that's following in this paddock. Exactly the same thing's got to happen. We take the direct costs and grazing income that has occurred in the previous financial year to the harvest and bring it into that financial year. So we're matching the crop to the financial year. And I've just drawn it at the 1st of January, 30th of December, because that's the easiest split. And I would suggest that makes the whole thing a lot simpler. Now, staying on the trading accounts, let's have a look at a trading account for a mixed farming business. And we've only got sheep and cropping. And you can see these are all the transfers, those ones that have been highlighted. We have $24,000 of the cropping income is coming from the lambs, but it's a direct cost. So it's a transfer on the cropping side, but it's a direct cost on the lamb side because they've turned it into dung. Barley grazing stubble, it's a direct cost to the wool or ewes, whatever you want to call them. And then the grain fed to lambs is a direct cost to lambs because they've utilised that feed and turned it into dung. It's not available then for elsewhere. Let's go then to the gross margin. And you can see the non-cash direct costs highlighted. They are the transfers that are happening in a grazing system. And we have the $24,000 of the wheat, the barley stubble going to the ewes, and a direct cost of the grain fed to the lambs and the grazing of the wheat crop for the lambs. So you can see that they're transfers in the trading account and they become direct costs in the gross margin. We also have a couple of transfers. We have lambs sold to the lamb enterprise. So these lambs have come out of the ewe enterprise. They've been born in the ewe enterprise, and we've sold them to the lamb enterprise. And then we've got, this is a self-replacing mob. So then we've got the ewe lambs being sold to the wool enterprise. So that's giving you an idea of how that operates. Is it worthwhile? Incredibly worthwhile. Once you go through that process of splitting it up into enterprises and being able to compare enterprises, then it becomes then you can really start to delve into your business and start to make some strategic decisions and get rid of those lazy enterprises and make your business simpler, usually in the process. It's all about that strategic decision making. Decision making is a key to good management. Farmer. Definition of a farmer: someone who does precision guesswork based on unreliable data provided by those of questionable knowledge. See wizard magician. Yeah. So often in our industry, I see decision paralysis. And the harder the decision, the more paralysis I see. And I've seen so often where there's a really hard decision, and rather than facing that decision, people will go and put up a fence because they'll work really hard, and then when they come home, they're too tired to make a decision, to make the decision. I would suggest that a good manager is really only good for 6 to 8 decisions a year that make a significant difference to your business. And if you're not in the position to make those, then your management quality suffers. If I go to a corporate farm where there's quite a staff and you catch the manager, doing fences or whatever, he should be sacked. It's not his job. He's got to look for those significant decisions. And a really good example highlighted to me was when my brother and I did our succession and we split our business. My brother loves being in the shearing shed and I hate it. And soon after the succession was completed, I had to shear some lambs in the middle of summer. And I could see that the week coming up for the lamb shearing was going to be, in the 36 to 40 degrees, like stinking hot. And I said, bugger it, I'm my own boss now. And I think a wool roller at that stage was $120 a day. Said, I'll pay a wool roller to do it, and I'll do something else. Well, I didn't have much to do. It was too hot to go outside. I'd drive around in the air-conditioned ute and have a look at stuff and, have a swim with the kids or whatever. I wasn't that flat out. But it's interesting that when I was driving around, I noticed that this hot weather had a significant effect on my feed. And that feed had lost its quality and quantity. And it started to make me concerned. I raced home and did up my grazing chart and did a feed budget and worked out that I needed to start to adjust my stocking rate if I was going to be able to go through this hot period, and it was a bit dry as well, without having to spend money feeding. Because remember, even if you're feeding out your own feed, it's costing you money because you could have sold it somewhere else. So I made a strategic decision and I sold the lambs straight off the board. And in hindsight, that decision over that year, or the following year or 18 months, made me about $350,000 because I destocked in a reasonable time. And I only think if I'd been in the shed for a week, and how many weeks that decision would have been delayed because I was too buggered after shearing and got caught up in the minutiae of operations. So not making some decisions can cost you a lot in energy, in time, and certainly in money. And you shouldn't give away your control. So decision making, you can only make the best decision you can with the information you have at this point in time. However, you must start to take action to guarantee that you will have more relevant information next time you need to make a decision like that. And this is where the business analysis becomes so important, because it backs up any strategic decisions that you need in black and white, in numbers. We need to have that. If we don't have that, then we're really just shooting in the dark. So we have a professional management model with RCS, and we want business improvement. We always want to be more profitable and a better business, but also we want to have life improvement, spending more time with the family, doing those things that are important in our life. We start off with our production systems, and we have three parts to our production system. We have our land data. How good is our soil? How good is our ecology? Is it operating as best as it can? Then we have our production data. How the animals, are they producing enough lambs or enough calves? Are they putting on enough weight where they are? What their genetics is like? All that type of thing. And then we have our financial data, and that's the results of selling our production. How well and how our business is going through our operations. And that is meaningful information. You would have all that information you need to make it into meaningful data. Unfortunately, with our financial data, it is all tax-based. It has nothing to do with profitability. It is basically for the tax department. We need to manipulate that so we can start to analyse our business well. But we're only halfway there. We also need the people, and the people need to have goals and directions. And I would suggest that this is the most important part in decision making. How often do you hop in a car without a destination in mind? It's ridiculous. But if you hopped in a car and just started driving, what happens when you had a fork in the road? Which way would you take? Doesn't matter, because you haven't got a destination in mind. And it's exactly the same for businesses. If you have no direction or no goals, it doesn't matter what you do. So it's really important to have the people involved with the business and the stakeholders to have clear directions and goals. And that allows you then to make those decisions. And that is our professional management model. We start to gather the knowledge, and then you need to build the skills around it. I would suggest that this recording has allowed you to see what we need to do. But it's also brought up some questions on what we need to do. Now we need to start probably building more knowledge, but importantly, starting to build those skills to be able to manage those businesses effectively and profitably. We need to get profit back into our industry, and the profit not only generates or benefits the agricultural industry, but it benefits all those businesses that rely on us in our regional centres. Let's try and reverse the slow deterioration that we're seeing in our communities through profit. Okay. Thank you very much for your patience, and please get in contact. See ya.